June 2022, the first ever case of insider trading to hit the NFT world. A former employee of OpenSea, the largest NFT marketplace, has been charged with wire fraud and money laundering. The feds busted him in New York, and he could go to jail for up to 40 years. Both the US attorneys and the FBI made a significant promise. From now on, they'll go after crypto insider trading systematically and aggressively. If you do anything in the crypto space, you need to understand this. So is it the beginning of the war on crypto?
If it's more they want, it's more they'll get.
Well, the most valuable commodity in the world used to be gold or oil. Today, it's information. Why? It's simple. Because he who has the most information wins.
I don't throw darts at a board. I bet on sure things.
Wall Street in the 80s was essentially one big bender. With the right tip, you could have made a fortune. Take Ivan Boesky, nicknamed Ivan the Terrible. He was a huge stock trader that took New York City by storm. Those were the days of hostile takeovers when a company would literally acquire and crush another. And Boesky made money by betting on every major business deal. But how was he always right? Well, he was betting on sure things. It turns out he had an intricate web of corporate informers. He knew bankers, entrepreneurs, everybody. He paid them to know about all the big deals before they even happened. Texaco, Chevron, Getty Oil, he owned them all. But greed is a funny thing.
Greed, for lack of a better word, is good. Greed is right. Greed works.
In fact, in the 1920s, there was a man named Albert H. Wiggin. He was the head of this little corner bank called Chase. In those days, the stock market was pretty much unregulated, and good old Albert had an idea. The economic crash was coming, so in order to capitalize on the crash, he opened up a short position against his own bank. And so when 1929 arrived and people were running for their lives, he made a tidy $4 million. That's $65 million in today's money, not a bad start to the Great Depression. But Albert wasn't done. He proceeded to ask for a pension of 100 grand a year from his own bank, the one that had just disintegrated. Yeah, the public shock from this level of corruption was so strong that it led to the adoption of the Securities Exchange Act in 1934. This created the SEC and to this day regulates market frauds. But what actually constitutes insider trading? Because it's not always illegal. Insider trading exists in Wall Street, in Washington, D.C., even at the dinner table. Basically, anywhere money is invested, it's happening. Legally speaking, insider trading is determined by these simple factors. It's about trading stocks of a public company using information that's material and non-public in a way that violates your fiduciary duty. In other words, do you know something that nobody else knows about a public company that could make you a ton of money? And somehow you shouldn't use this information, then keep your mouth shut. Do nothing. Or at the very least, if you're gonna do it, be subtle about it.
There's always money in a banana stand.
But seriously, don't do that. If you trade on that information, they will come after you. And if you're an employee of a company, like the director or manager, it's even worse.
That's the Securities and Exchange Commission. They have votes?
Now meet Nathaniel Chastain. He's the former head of product at OpenSea, king of the NFT marketplaces. According to Chainalysis, the NFT market was worth more than $40 billion in 2021. It's a gold mine, and the opportunities to make money are right there for the taking. So here's what caught the FBI's attention. OpenSea had this thing where they would feature a new NFT collection right on their homepage. The featured NFTs changed every week, and of course the identity of those features were super secret. That's because after being promoted, their price would increase every single time, together with the price of all other NFTs by that same creator. It's like people discover Picasso, and so all the other paintings by Picasso are suddenly selling out faster than Gamer Girl bathwater. So Nate, as one of the managers, knew which NFTs were going to be picked before the public knew. His job was literally choosing the investments that were bound to go up. And what did he do? Exactly what you think he would do. According to the indictment, he bought 45 NFTs for himself. Between June and September 2021, he used confidential information to buy the chosen NFTs before they were featured on OpenSea. Then, of course, the price would skyrocket and he would sell them for big, big bucks. Just imagine you're the curator of a museum. You decide that tomorrow you'll feature some new Italian painter that suddenly will become cool and valuable. And the night before, you of course buy all of his paintings for a few $100 just to sell them days later for a load of money. That's essentially what he did, and he repeated the fraud at least 11 times. For example, on August 9th, 2021, he bought 10 flipping and spinning NFTs, and then sold them for 3 times the price. Or again, on September 14th, he bought the NFT called Spectrum of a Ramanification Theory, together with 3 more from the same creator, and then he sold them the next morning for 4 times higher. Now, Nate managed to fly under the radar and keep this operation going for a while. In fact, he made these purchases using anonymous OpenSea accounts and crypto wallets. After that, he would then launder the money by moving the funds through several Ethereum accounts. For this reason, OpenSea didn't realize what was happening right under their noses. But then a few members of the crypto community began noticing these unusual transactions and began flagging them. That's when hit the fan and OpenSea realized they had a major problem. As the main marketplace for NFTs, you just can't afford this type of scandal. It can kill you.
Frozen banana stand, a Newport Beach landmark, burns to the ground. A delicious whodunit. After this.
So they immediately had an investigation to see who and how many people were doing this, and on September 15th they wrote a post. They apologized and announced that Nate Chastain had been forced to resign. So where is he now? He was just released on bail for $100 grand.
You love it here?
Ah, I'm having the time of my life.
He's waiting for his trial and potentially faces up to 40 years in prison. But that's not all, because things are getting dark for the NFT world. The DOJ might be mounting an attack, and here's the problem. According to the classical theory of insider trading, when a corporate insider trades using confidential information, he commits fraud simply because he violates the fiduciary duty towards his company. But is the crypto world any different? Are the employees of OpenSea tied by a fiduciary duty towards OpenSea? Absolutely. OpenSea immediately told the feds and district attorneys that all employees are asked to sign a written agreement of confidentiality. So when they join, they pledge not to use this inside business information. And that's the only way to trust that the NFT market functions properly. So Chastain won't be able to defend himself using that one. But there's another issue here. One of the key aspects of the crypto world is that legally, NFTs are not securities. So all the legislation regarding the SEC, market frauds, insider trading, it can't be directly applied to cryptos. That's why many people thought that law enforcement was just going to stay away from the crypto world. Like, we don't know how to manage this, so we'll just leave it be. But here's the bomb. In this indictment, for the first time, the FBI and the district attorneys claim that this distinction does not matter. It's only a technicality. Securities or not, they stepped into the Web3 space and they'll go after these people with any means necessary.
We are here because of you, Mr. Anderson. We're here to take from you what you tried to take from us.
Now, before getting into which types of insider trading are perfectly legal, let's say this. Safety and transparency in the NFT market are obviously good and essential. Because otherwise, how can you make any investment if there are insiders and scammers making all the money? But the fact is that insider trading has unclear borders. It's more widespread than you would possibly imagine. Do you remember that fella Wiggin that made money in 1929 by betting against his own bank? Crazy. Well, in the recent 2008 crisis, people lost houses, jobs, and pensions. And while the economy was melting down, some members of the US Congress had inside information about the markets themselves and used that information to make piles of cash. This scandal forced Obama to stop it by promoting the Stock Act of 2012. Did that help? Not really. In fact, in 2020, some members of Congress knew before anyone else about the upcoming COVID-19 crisis, how that would impact the economy, and they managed to profit from it. Now, let's just assume for a second that NFTs are treated as securities. Could you, a casual NFT investor, actually be committing insider trading? What if you want to use some information you obtained legally, or what if it's a tip that you just hear on the streets? Insider trading is about using material, non-public information to trade in a way that breaks a fiduciary duty. And this duty is the key point here. Take this example. A few years ago, there was a young financial analyst who worked at Amazon. And due to his job, this guy knew exactly what Amazon's quarterly results would be before they were announced to the public. This is huge. So he decided to make some cash off of it. He talked to his brother and told him what the results would be. And this guy made over $100 grand with the trade. Well, the FBI found out and they went hard on him. He was fired from Amazon and was sentenced to 6 months in prison. But his brother was liable too, and that's because both of them knew the information was classified, so both breached the fiduciary duty. Not to go too nerdy on you, but this principle was established in the case Dirks versus the SEC in 1983. And basically it says that even if you're outside of a company, if you get information and you trade on it, knowing it's confidential, then you are going to go down as well. So technically, if Chastain told someone outside of OpenSea what the chosen NFTs were going to be, then that outsider would likely be liable as well. But what if you just overhear something big? It's not too nefarious. Well, meet Barry Schweitzer. the former football coach of the Dallas Cowboys. In 1981, Barry was at a track meet watching his son, and it so happened that seated right in front of him was this big shot executive from an oil and gas company. This fella, George Platt, was talking to his wife about how he wanted to sell his company, Phoenix Resources, and he said they were ready to close this big deal. Barry heard this and immediately talked to a couple friends. They put some money together and bought a large stock position in this company, and it worked. Barry made an insane profit before immediately getting busted by the SEC. However, in that case, the court found Schweitzer to be innocent. He just overheard the information. He wasn't told this information. The guy didn't even know Barry was sitting behind him, so there was no fiduciary duty at all, and that's important. So he kept the money and went on to win the Super Bowl a few years later. So if you talk business in public, speak low. If you hear business in public, listen up.